Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, a common thing that's discussed in the press almost ad nauseum every single week is interest rates. Where are they heading? What's happening to interest rates? Are they going to go down? We thought it was worthwhile to take a bit of a helicopter view on interest rates and ask ourselves, what are all the ways that interest rates can affect someone in business? And there are many wide-reaching ways that interest rates do have an impact. And I think helping people understand the far-reaching consequences of interest rates, I think helps people then understand, are they important or how important are they in your business? And then how can you navigate those changes and what impact will those changes have on your business? And so what Mena and I will do is take turns in mentioning, some of the ways that interest rates can impact business and then how you can mitigate them. So the first thing that I want to talk about is valuations. Interest rates do play a role in how a business is valued, and essentially it alters the required rate of return. And the reason for that is the required rate of return that someone is looking for when they buy a business is a combination of two factors. The first factor is the risk-free rate of return. What rate of return can they get without taking any risk? And the best proxy for that is a short or longer term government bond. The yield curve's pretty flat at the moment, so whether it's a 10-year bond or a 30-day bank bill, it doesn't really change that much. But that gives us the idea or the base level, if you like, of what the risk-free rate is. And then on top of that, you need to add a premium for the risk that you're taking by investing in that business. And the risk that you're taking is that the subsequent annual cash flows from that business, so that is the net profit that it makes, might vary to what you expect. So a business that is very mature, that produces very stable cash flows, let's even assume their income is all under contract and that the fixed costs are really, or the costs in the business are very ascertainable, they're not going to go anywhere. In that situation, that business is going to produce a very predictable level of profit. You might only want a smaller return for that. However, if I'm investing in a startup, for instance, God knows what the profit will be next year. It's anyone's guess. You may as well throw a dart at a dartboard. Of course, you're going to want a higher rate of return. So when interest rates are high, business values are lower because that risk-free rate of return is much higher, and the reverse is true as well. So at the moment, interest rate settings are relatively high, which would suggest that business multiples, that they sell on, either 4 or 5 times profit, whatever it might be, will be compressed somewhat just because of that risk-free rate being higher. And in a low interest rate environment, and we remember through COVID when interest rates were close to zero, the stock market was running high. Part of that fundamental reason, a lot of it was exuberance, but part of the fundamental reason is that interest rates were lower, and of course that increases valuation multiples.
The other consideration is when interest rates are high, people typically think about cost of capital, your loans and so forth, because that's really cash outflow as your loan repayments increase and so forth. But the other consideration is actually inventory and payment terms. Now, because the inventory is just assets and it sits on a shelf until sold, inventory holding costs rise because you basically have just cash sitting there until it's actually turned over. So as interest rates rise, so do inventory holding costs. And then as a result, your creditors may also want to be paid faster because they're experiencing the same cost pressures. So in business, it's not always just about the cost of capital, but also could relate to your assets as well.
The next thing to think about is how it impacts customer demand for your business. So whether your customer is a retail client, a consumer client, of course, then interest rates impact, the amount consumers have to spend, particularly those with mortgages. Some consumers are impacted positively by interest rates. If your consumer is, for example, retirees, self-funded retirees, well then higher interest rate settings are actually going to improve their cash flow rather than reduce it. And then, of course, business businesses as well. So again, depending on how the business is funded, but if businesses borrow and have borrowings and in a higher borrowing environment, of course, business demand could be lower for your products.
So how can you navigate all this? So some sectors are obviously less sensitive. So, there's out of COVID, you saw some industries that are considered somewhat recession proof, things like such as your grocery chains and the like. Regardless of inflation and COVID pressures, it's, those businesses generally are going to do quite well. But if you're in a business that's quite discretionary in nature, then obviously you need to do things to help sort of navigate these cost pressures, whether it's sort of reduce your fixed costs or variable costs in terms of staff wages and so forth. Or if you can contract revenue, that would also sort of stabilise your income. But irrespective, valuations aren't going to be something you're going to be concerned about if you generally want to retain your business. But obviously if you want to sell your business, then the idea is to basically, reduce costs, try to increase profits and, be in a position to basically improve your multiple to assist your selling.
So there you go. Interest rates are wide-ranging. It's not just about, they impact people with borrowings and so forth. There's a lot of, greater or wider ranging impact on businesses. And I think it's really important to understand, how it impacts your business, as Mena suggested, and then think about the ways to mitigate that. It's quite common in Australia and the US for businesses to be relatively highly leveraged. Not in all industries, of course, but in some. Whereas it's kind of interesting in Western Europe, a lot of businesses are family-owned businesses. Even the listed businesses still have some family-owned sort of nature to them. And they tend to not have very much in the way of borrowings, and they tend to hold a large amount of cash. It's a lesson we can learn because a lot of those businesses are several hundred years old, sometimes thousands of years old. So they've stood the test of time, and that leverage and exposure to interest rates can be a risk to the business that we must mitigate, manage, and be sensitive to. Okay, that's it for us for this week. Until next week, bye for now.